Welcome to the Unconventional Investor Podcast. I'm your host, Michelle Moses, certified financial planner, licensed realtor, and founder of Me Financial. If you're an accredited investor feeling overwhelmed by managing your portfolio and looking for alternative investment strategies that go beyond the traditional stock market, you're in the right place. Let's head into today's episode so you can start taking control of your financial future. Hello, everyone, and thank you so much for tuning in. Today, we are going to be talking about crowdfunding, specifically about how community-backed startups are beating out venture capitalist companies. And today, to talk about that, I have Sherwood Woodie Neiss to talk about this. And he is a venture capitalist, the policy architect behind the Jobs Act, and the author of Investomers, a book on how customers are becoming the next wave of startup investors. As the co-creator of the law that legalized investment crowdfunding, Woodie's message is that capital isn't just coming from Wall Street anymore, it's coming from the community. He's testified before Congress, advised the World Bank, and now uses AI to analyze thousands of early stage deals through his firm D3VC AI. Thank you so much for being on, Woodie.
Thank you so much. It's super exciting to be here today.
Yeah, I am excited to hear about this because I remember when the Jobs Act came out and the whole crowdfunding thing, because, you know, my whole thing is accredited investors and alternative investments, but I'm always looking for ways for non-accredited investors to get into things. So when the Jobs Act came out and crowdfunding became, you know, legal, I was so excited. And I'm glad to see that you're utilizing it because you don't see tons of people utilizing it. And the way that, you know, I don't know if that's because of paperwork or whatever. So we'll get into that of how to, you know, get more people to be using it. But first, why don't you kind of tell us about how you got started in all of this and how did you even become the person to, you know, be in front of Congress and creating the Jobs Act?
The right place at the right time.
Yeah.
So I was living in Washington, D.C., which made all of this incredibly helpful because, you know, that's where the policy gets made. I had started my career on Wall Street, worked on the trading floor for Payne Weber, went out to Silicon Valley, worked for a venture capital, started a backed company, learned all about VCs, started my own healthcare technology company called Flavor RX. We flavored medicines for children so they're more compliant. Grew that from one pharmacy to 40,000. We were VC funded, sold that to a private equity group. But I always got these calls from mothers saying, you know, I got my kid to take medicine. Never could I get him to take medicine before. How do I invest in your business? And I'm like, listen, you can't. Like, these laws were written in 1933 to protect people like you from investing in risky startups like mine. And they're like, but I really believe in you. And so after we sold Flavor X, I said to two of my friends, this is a missed opportunity. Like, right now, this was in 2007, 2008. It's like Washington, D.C. is looking for jobs. It's the Great Recession. Why don't we finally update these securities laws to the internet age? And that's what we did. We sat down, wrote an 8-bullet-point framework, walked over to the SEC with it. They said it was cute to go to the building with a white dome. And, you know, naively enough, we literally started walking the halls of Congress.
Really?
Both sides of the aisle, spoke to everyone. I got people very interested in what we were doing, particularly because we were talking to staffers, not the senators or the Congress people themselves, but the staffers. And we'd be like, do you know you can't invest in any startups? Like, you're not smart enough. And the staffers were like, what are you talking about? Of course I can. Like, no, actually, these laws that, you know, were written in 1933 prevent you from investing. And so we were able to get them engaged in what we were doing. And they were able to go to their bosses and be like, well, this law just needs to be updated. A hearing was called. The White House had someone at that hearing. They called me. I promptly hung up on them because I thought it was a friend placing a prank call on me. They called back and said, no, this is actually the White House calling. We're very interested in what you're doing. Gave them a 2-page write-up. And 2 months later, President Obama came out with a statement of administrative support, which is like the highest press. It's like literally, it's that, put it on my desk, I will sign it into law. And it passed the House 40717, the Senate 7326, and we were at the White House for the bill signing ceremony.
That is amazing. And you don't ever hear, I feel like you don't hear about bills passing that quickly. I mean, that's like really quick for just a couple months. And I'm sure a lot of it had to do that you were talking to younger people that were very internet savvy and realized like, hey, this is an issue.
It was 460 days from when we walked into the halls of Congress until we were sitting in the White House. Even at the bill signing ceremony, President Obama said this is one of the fastest pieces of legislation to go through Congress. And, other than naming a street. So, yeah, I mean, great timing.
Yeah, it sounds like it was just meant to be. I mean, that's absolutely wonderful. Well, I have to thank you for doing that because I was excited when it came out. So I'm very excited to meet the person that did it. So you did see a need, and that is what happens. That's what happens to me just as an advisor is that people call, well, how can I get into this water technology that, desalinates the water and how do I, just like all that different stuff. I'm like, you can't. You have to be a venture capitalist, and the minimum of that, you got to have millions of dollars. There's just no way that you're going to be able to do that. So, okay. So congratulations on getting it passed. That is really awesome. And I think there's millions of us that thank you for doing that. And so where has it gone since it has been passed? And like, what are you seeing out there?
Well, it took 4 years for the SEC to come up with the regulations. So
of course.
It passed in 2016, 2012. It went live in 2016. And since then, about 8,300 companies have now used this to do 10,000 rounds of financing. Over nearly $3 billion has been raised by these companies in 500 different NAICS, which is like an industry classification code, in 2,300 cities across the United States. 50% of the companies that were raising money last month had either a women or minority founder. So it's been transformative for them. And it's just, we're seeing the evolution of companies coming in change as well. It used to be pre-revenue, early stage companies coming in less than 3 years old. Now these companies have an average revenue of $1 million and they're over 3 years old. So the risk profile has drastically changed. The other thing that's changed as well is when this launched, VCs were like, don't touch it. It's not, these are the, adverse selection companies. But now you're seeing a lot of VCs on the cap table. VCs are syndicating these deals on these platforms because they realize the crowd can do something that they can't. They can buy marketing and advertising, but they can't do it in a viral way that the crowd can. And so when you convert these customers into investors, or as we call them, Investomers, you actually turn them into brand advocates, and they're bringing customers, sales, future investors into these companies. And it's been really transformative for the businesses themselves.
Absolutely. So what you're seeing is more experienced businesses coming forth wanting to crowdfund because they're needing to raise money to probably develop something or grow their business.
Yeah, I mean, it's the entire spectrum. When this got started, we thought it was just going to be software technology companies. We thought there was going to be an opportunity for debt crowdfunding. So the whole Main Street type of retail businesses that are cash flowing has been a whole vertical within this sector that has not received the attention that I think it deserves, only because the yields for investors are as high as 10% right now. So it's really attractive. And the default rates are much lower than bank loans because people, issuers don't want to let down their customers. Unlike issuers that go into a bank and like, who's the bank loan? I don't care.
Right.
So it's completely different. Right. But when you on the other side, with the equity side, it's just seen this huge influx of fascinating companies. I mean, the companies that we're looking at are healthcare technology companies that are both early stage and ones that are going through clinical trials right now. You've got AI in a lot of what's happening in the space. And it's just fascinating, the whole spectrum of opportunities here. But the opportunity, this whole industry is burgeoning right now because VCs have stepped out of the space. In what we saw a couple of years ago with the collapse of Silicon Valley Bank, they started to sit on the sidelines. And that created this opportunity for these startups to be like, I still need capital. Whether or not you are investing, we still need money. So they're going online to these platforms and they're raising money up to $5 million a year from their investors, the crowd, to help them achieve these goals that they couldn't do with VCs because they're not there anymore.
And so you think the drive for the growth has come from the VCs kind of stepping to the side, and now this is their other option besides going into the the retail space of financial advisors and things. This is another option for them to go through.
Oh yeah, most people don't even know about investment crowdfunding today. And so, I mean, by the fact that there's only been 8,300 companies, and you can consider the hundreds of thousands of them that are out there in the United States. So we're at the early stages And by the way, I think the whole landscape for the venture market has shifted. People are like, well, when things calm down, VCs will come back in. I'm like, yeah, no, I think they've gone upstream. I think they realize deals are less risky the bigger they are, the more revenue that they have. And it's created this void for early stage investing.
Oh,
And
so
that's
they're
why,
going with more tried and true companies.
oh, yeah. I
Okay.
mean, I think there will be early stage funds like the one that we started that invest in this space. But we still have to get them into the marketplace. I think a lot of the funds that are out there are just going to move upstream with the bigger deals.
And so how do people find out about crowdfunding and how to do it? Like a company. So they go to a lawyer or they go into a bank and looking for money and somebody mentions it. How do they find out about this?
I mean, the easiest thing to do is just go to Google and type in investment crowdfunding.
That's what I would say. But, are people they don't know that they can even do it? And then, or are these business owners, they're pretty savvy and they know that they can do it. And so they're exploring it.
No, I think you have a point. I think education is missing. What we're doing right now is helping increase awareness of what's happening in the marketplace. You can go to the biggest websites are Start Engine, WeFunder, Republic on the equity side, Honeycomb and the SMBX on the debt side. I would tell anyone, just go there, look at the deals, see how people are marketing their offerings. This is a regulated process. So you have to go through disclosures. In some cases, you have to have audits. So you have to see what other people are doing. And because it's a standardized, it's a process you go through. So it takes a lot of the brain work out of it to know that, well, I just need to complete these fields. I need to complete these disclosure documents. And I too can go out and try and raise money for my customers or friends and family.
And so what is you kind of said something about that it is regulated and that some are having to go through audits. What would make someone have to have an audit and not have an audit?
Sorry.
That's okay.
If you've had an audit before, you need to have an audit again.
Okay.
That's the main thing. So you can't have had an audit and then be like, I don't want to have audited financials. If you're a first-time issuer through investment crowdfunding, for the most part, you don't need an audit. If you're raising over a certain amount, the audits might be necessary. But for the most people that are out there raising in their first round, you're going to need financials for the most part that are reviewed by a CPA. Which, by the way, is not an easy process. So you've got certified financials up to 124,000, CPA reviewed financials over 124,000, and that's where you're going to have to spend some time with an accounting firm going through your books and all that stuff, showing them how you receive money, how you do inventory. But it's just a very high-level review of what you would do through a really deep audit.
Yeah, and I don't think that there's any way that you can raise money that you aren't going to have to do a lot of work as a business owner, right? I mean, even if you were to go with venture capitalists, you're going to have to get your ducks, this is getting your ducks in a row. And even in what I call the retail space of going to financial advisors, you have to get your ducks in a row and register it with the SEC too, so there's a lot of homework that goes through, any channel. Do people pick two channels or do they normally just pick the crowdfunding channel and then that's it?
Well, I often tell people that raising capital is like getting on a highway. There's multiple lanes and there's cars going down. You actually have to be in multiple cars. So investment crowdfunding is one lane, and you could have an accredited investor offering, a 506c offering. We're seeing a lot of these companies doing parallel offerings because with the $5 million cap that you have in investment crowdfunding, if you do a parallel offering with a 506c, you essentially can raise an unlimited amount of money.
Right.
So you don't have to be limited to one or the other. But what we do find is a lot of companies that are just getting their feet wet and want to learn about it, stick with an investment crowdfunding offering, go to, WeFunder, one of those platforms, and do a small offering and understand the process. I don't know if you remember back in the early 2000s, this whole lean startup methodology world was very popular then, and companies only raised as much as they needed. And that was like the mantra. And then all of a sudden, VCs were like, here's big checks, millions of dollars, spend, spend, spend. And it changed the whole rationale. Well, VCs, again, like I said, they're gone. Startups still need money. They're raising money in its lean startup methodology right now, which is I'm only going to raise a small amount, do smaller rounds of financing. I'm going to set milestones. I'm going to achieve those milestones. I'm going to report back to my investors, which, by the way, is brilliant in terms of communication and accountability. It allows you to attract VCs later on, but they're going to go back to the crowd and they're going to do another round of financing. And the best part about that is when VCs invest in companies, they have to wait for another institutional round or another round to price that follow-on round. When these companies are doing these smaller rounds, they're doing incremental valuation increases over time because they've proven that they can achieve their milestones. Every time they mark it up, we get to see what that incremental increase is. And so we have this database that has every single offering in it, and we track every single valuation round. And so we can see these increases that are happening, and it's fascinating to watch the wealth creation that is happening right in front of our eyes.
And do you mean wealth creation for everybody, for the company and for the crowd, the investors?
Absolutely. It's great for the company and the founders themselves because they're building wealth for themselves and their families. But for all of these investors that are getting in, this is the first time retail investors are able to be like mini venture capitalists. Mm-hmm. And they can come in and invest really on the same terms as VCs and get in on these deals at the earliest stages, the lowest valuations in many cases, and just watch that opportunity grow. Now, nothing changes just because this exists. And people should be thinking, how much am I really willing to risk? Because failure is always an option. So you have to keep your eyes wide open and think about that. But I will tell you, a data point that we have in our data set is longevity of these firms. Now, the SBA will tell you that 50% of startups will go out of business within the first 5 years. We've been tracking all this data since 2016, and every year we run an analysis to see how many companies are out of business. So since 2016, 21.7% of the companies that started are out of business. So we've got companies that are sticking around much longer than your traditional company, which is great for, wealth creation, the odds of you actually doing well in your investments as well. But this is still a risky investment, and people should consider that before they decide, what am I going to put in
Yeah,
this?
Absolutely, because it is a startup and it is tight. Things are lean, and I had an I have only done it twice, and I invested in a bread bakery here in town, and we did it on mainvest.com, and Mainvest went under. Yeah. Something happened with their banking or something like that. So is that the only risk in terms of, because if you're going on WeFunder or one of these websites, there is a risk that they would go under, but you still have your investment with that company, right? The paperwork is still there. It's just that they were the facilitator. And if they go under, it's not a huge deal. Like it's a big deal, but it's a pain in the butt, but it's not like you lose your investment. Right.
They had to have a wind down procedure that would allow all the investors to know that they would still get their monthly payments. That's part of what you sign up for when you're a platform.
Okay.
With WeFunder, one of the equity ones, you actually have the shares. Like you're on the cap table. So if WeFunder or one of the bigger platforms were to go out of business, it really wouldn't affect you, only because you still have that stock certificate.
Okay. And then back to your comment about only having 21% of the new companies go under. I would imagine that there's less because in the SBA loans, those are pretty hefty payments, right? That's pretty big, and it takes a lot to go through it. But that's one lender. And as you were saying, it's not like you have this crowd that you are not only marketing to, but they're your investors. I would think that would be some sort of incentive too, that you that the benefit of having all of these people that know about your company are getting updates about your company and then are talking about it on the street because they want to see their investment improve, right? I'm sure, the mix between all of that is very interesting, as to why they do succeed.
That is where we are today. You have hit the inflection point that is taking place, which is before investors were people that you met but didn't necessarily know. Now we are at this evolution where every company is going to be looking at their customers, not just for someone that buys their product or service, but as a marketing agent for their business. And they're going to want them to be investors in their business if they think there's the opportunity for that business to be sold, merge, or go public. And that's what we're looking at, is all of these individual investors going, this is another term I coined. It's called the influvestor. So you know how TikTok, all these millennials, and by the way, if you're listening to this, you have to remember everything that's happening is because of this millennial revolution as well. So a lot of all that's happening around us is people thinking these millennials are the future investors. These millennials are the future entrepreneurs. How are we helping them? How are we investing in them? And so TikTok is social media, and we've got these influencers that are telling us, buy the viral Dubai chocolate. It's amazing. And everyone's like, okay, I'll try it. But what's the evolution of this marketplace is you're now an investor in my business. Go on TikTok and tell a story about why you invested. Why do you love our company so much? Why do you love the product or service? Tell people about that. Tell people about our offering. Bring them in, and they're going to be driving people into these companies through social media. And this is just the beginning of that whole movement as well.
Oh, I love that. I mean, I would think that, yes, that would, now that you say it, it's obvious like side thing that has happened, but just in the way that everything works. But I love that so much. That's such a great idea. And I mean, it's free marketing for this company, basically. I mean, it's more of, instead of marketing, which is a lot of times, I call it just throwing stuff against a wall and seeing what sticks.
Absolutely.
Whereas this is, you've actually got people on the ground that are invested in your business and they have an interest in having it succeed. So yeah, that's really cool. And so what are you seeing in your company? So it's D3VC AI. So you are analyzing all of these crowdfunding companies, the companies that crowdfund. What are other things that you're seeing? So are you analyzing them for like 100 different things, or, does it change every day? How does that go?
So the key difference in what we do to what VCs do is we follow investor sentiment. So we believe that if the number of checks that are written every day into an offering and the dollar amount that's being committed every day into an offering are two signals that should be telling us something that we don't know. So where you've got a crowd of people swarming into a deal, what is going on? What do they see that I don't see? What is happening that they are so excited about that I don't know about? So we look for that as a signal. Then we also look at how much money is going in, because if it's a lot of small checks, that's interesting. But if the average check size is higher than normal, these people are willing to risk a lot more money. I want to follow that signal. So we created an algorithm. There's 150 data points we collect on each offering. There's over 5 million data points in our entire data set. And every day there's new companies coming in, and every day there's companies raising capital. Companies file annual reports. So there's all this data that we're pulling in. And we created an algorithm to look for signals in the data set of companies that are most likely to go on for a follow-on round of financing. Not a company that is going to have a successful exit, because I don't think anyone can predict that. But there's enough learning now in these models where you can look at the signals of other companies that have gone on for follow-on round of financing and see if that exists in the current company. And you follow those signals, you layer on the investor sentiment. Every week we get a ranking of all of these companies, and we do what VCs do at that point. We go through the deal, we go through the financials, we look at their IP, we look at the team. We send questions to them. By the way, if you're listening to this and you're interested in this, go to the comment section on these offering pages on WeFunder or Start Engine. Read the comments. You will be blown away at the knowledge and depth of questions that these investors have. These are not like necessarily retail investors that know nothing, that might just know the CEO and want to invest. These are scientists. These are doctors. These are people that are PhDs that know these industries inside and out and ask very, very telling questions, for which, if there's a good answer, it builds confidence in you as an investor to want to come in. If they're silent, hey, that's a signal.
Right.
If they're not answering that now, who's to say that they're going to answer later on? So VCs are also looking at this to be how transparent and forthcoming these companies are, because it's a great metric, a gauge for them to know, should I invest in this company later on?
Absolutely. I could see that for sure. And I mean, just like the comment section anywhere, it is, very interesting. But when you have all the science behind it, and I think it's just more of how responsive and how much they care about people. And I think crowdfunding also goes into that, right? Is that there's a lot of companies that want to do good in the world. They want to bring people together. And I think all of this allows that. And then being able to do all those comments and see all of that, it's the whole circle. It's the whole package,
Oh, it is. There's so many stories of issuers, entrepreneurs that have raised money from the crowd. I was just talking to a woman who started a company that's got $63 million in revenue now. She started with nothing, crowdfunded it. And VCs came in and they're like, we want to buy out the early stage investors. And she says, okay, as long as you are fair to them. So they had this conversation, and then they thought, you know what? They've actually built this business to where it is. Why buy them out now? Like, they've done the work that we need them to continue to do. But so you've got these entrepreneurs that do not want to let their crowd down either. And it's fascinating to see the dynamics of that taking place.
Absolutely. I mean, I could absolutely see that. Again, it's not just the one person or the bank or the people at Goldman Sachs. It's, it's a whole crowd of people that could go on social media and trash talk you or, whatever it is, that you're worried about or that you care about. So I think this is wonderful. And I'm glad that you're out here talking about this, because I have often wondered, why isn't it more popular? It's like there is the Reg D, stuff for accredited investors, and then they have the little sliver of things that aren't for accredited investors, but it's so time consuming and expensive to do. You don't see a lot of companies doing it. And so I think something like this would be a good option. And so is crowdfunding generally like as an offering, is it cheaper to crowdfund than it is to do the Reg D private placements?
I mean, I don't know if I know the true answer to that, only because I think a lot of venture capitalists want you to have an audit, and that's going to cost money. But, in a crowdfunding offering, an investment crowdfunding offering, you have to put a video together. Okay, that's going to cost money.
Mm-hmm.
You need to make sure that your marketing material
So you're doing
key.
more on the marketing end than you are in the paperwork end.
Yeah. So, we did a research report analyzing the costs that people spent outside of the fee that you pay for the transaction fee on each investment. And it was about 7% of the raise is what you're going to pay in terms of fees to get it to go live. So keep that in mind.
Mm-hmm.
The bigger that you are, of course, you can spread those costs over a wider net, but the smaller you are, it could cost a lot.
I don't think that's that expensive. In some of the Reg D private placements, 7% is just what you pay to a company to have it on their platform. So
right. Well, this is 7% in addition to probably 7% you're going to pay the platform itself.
Okay. All right. So, and if someone wants to raise money this way, I know this wasn't what you exactly, but if somebody had a company and they wanted to just explore the crowdfunding, would they just go to WeFunder and then they would be able, or someone like that, and they'd be able to point them in the right direction, or you go to a lawyer first, or?
We did write a book, Investomers.
Yes. Oh, so that's what your book is about, is how to do it.
Yeah. If you like, this is a very deep analytical dive into the world of investment crowdfunding. If you want to raise money, we've got a chapter that's in there, totally data driven on what we've seen in the most successful offerings that have raised the most money. And if you're an investor in there, we have a whole chapter in there on what you should look for in these companies. So I would tell people, spend your time learning about what's happening in the marketplace before you actually, put one of these offerings together, because you can't just throw something up. You can't throw a net out there and expect, all this money to come in. The very first thing you need to do, even before, if you're thinking about this, is consider, who's my crowd? How big is it? What have I done in terms of social media awareness, blogging, educating people about the problem that our company solves? You have to build that community before you crowdfund.
Right. So it is a lot like marketing. Because you're finding who your ideal customer is, and that sort of thing. Yeah.
Oh yeah.
Okay.
This is a whole marketing exercise.
And then where is your book? Is your book on Amazon and all the places?
Amazon, Barnes and Noble, but you can find out about our book and everything, D3VC and everything on investomersbook.com.
Okay. And then on D3VC, you analyze all these crowd funds and then you invest in some of these companies, right? And so people can also invest in your fund that then invests in how many hundreds of these other companies or...
Exactly.
Okay.
So think about it this way. In April, at the end of April, there were 650 active deals. Imagine if you're an investor and you're like, okay, where do I start? You sit in front of your computer, it's overload. Like, by the way, who's time to do that?
Right.
So
AI has time to do it.
Well, AI, yeah, exactly. But we thought, build the algorithm, let it feed us the results. Why don't we make our own investment decisions based on what we find, and people can invest in our fund. That way they can diversify in this, in a basket of opportunities that we are investing in, and they can benefit from it. And, some of our early results, and we've only been at this for, 10 months, is, we're seeing a 1.47% return because, going back to what I was telling you, a lot of these companies are doing these small rounds of financing, showing valuation increases. And it seems to be our algorithm and our team are really picking companies that are going on for those follow-on rounds.
Oh, that's wonderful. Okay, so there's multiple ways. You've got your book that can teach people how to fundraise, right? Mm-hmm. Or even how to invest. So if you want to get to know crowdfunding and what you might need to invest in, or they can have you do the work and just invest in your fund at D3VC.
That is correct.
Right. Okay. All right. Well, you guys, Woodie's book is called Investomers, and this has been so enlightening. And I'll tell you, I got to thank you again. I have to thank you again for getting this legislation through. I was so excited about it when it came through, and I just really believe that we're better when we're together, just in general, and people, our ideas. And then the crowdfunding, it's not only the money that's coming together, but it's the ideas and the social media and the talking, your network. Mm-hmm. I just don't know how things can fail when you're bringing a bunch of people together in one energy or spirit, kind of thing.
I mean, listen, I created the lemonade, so I'm fully have drunk the lemonade, but I firmly believe that the future unicorns, the future Facebooks, the future Googles are starting in this data set right now. This is the pond. So if you're interested in who are these companies and where they're going to be, pay attention to what's happening in the space, because it is evolving rapidly and it's fascinating.
Yeah, I believe it. So, wow. Well, thank you so much for all of this information. And thank you for sharing your book and your company. And you got a lot going on, and I am interested to read your book. I'm absolutely going to pick up your book and read it. And thank you for taking the time to speak with us. You guys, I'm going to have everything about Woodie in the show notes, about his book, his YouTube channel, how to learn more about his company. I'll have all of that in the show notes. If you have any questions, feel free to contact me or Woodie or, whoever you need to get out there to get started with some of your crowdfunding and get out of the stock market and into some things that you want or are interested in. That's the way I put it anyway. Woodie, how do you put it?
I think I couldn't have said it any better.
Okay, well, that's how I talk about it. So thanks again for being on. You guys, thank you so much for listening. Let me know if you have any questions, and I hope you have a wonderful day. Thank you for listening to the Unconventional Investor Podcast. I hope you feel more confident in how you can grow your wealth using the strategies I shared in this episode. If you're ready to take the next step in diversifying your portfolio outside the stock market with alternative investments, head to mefinancial.net/contact us to book a 15-minute consult call with me. Let's discuss how we can work together to achieve your financial goals. Until then, I'll see you on the next episode.